All right, this is part three. This is the Carrera example, and what we're going to do here is the operating activity section for an indirect cash flow statement. In part four, we'll do the direct method, but this one is about the indirect method, and we'll also discuss what we can learn from it from the cash flow statement. In part four, we'll come back with the direct method. Okay, so just to review from what we learned from the previous video, we had checked off all of the I's in the asset section and all of the F's in the liabilities and stockholders' equity section. And now we're going to focus on the O's, the operating activities. And they're a little bit harder because they're reconciliations as opposed to direct effect on cash. They are the difference between what's reported in net income and the cash flow effects. So they are just a little bit harder. So let's go back and look at our steps. In the last most recent thing we did was we explained the investing and financing activities. That's number 6. So we'll check off that. And now we're going to focus on compute the cash from operations using either or both the direct or indirect approaches. And since American companies typically report the indirect approach, we're going to start with the indirect one. And we're going to look for all of the O's that have not been checked off. The first one being accounts receivable. We'll focus on that, and we're going to look at, all right, we had accounts receivable that started out at 360 and ended up at 144. We'll put that in a T account. It's an asset with a balance on the left and ending balance is 144. Our decrease in accounts receivable is going to be explained by a collection. We got cash for $216,000. And so that's going to be a decrease in accounts receivable that has a positive effect on cash. And that's because that accounts receivable produced sales in the prior year that was collected this year. And as a result, it has a positive effect on cash this year that did not affect this year's net income. So we have a positive effect there, 216,000. So we can come back here and check that one off. Next, O is merchandise inventory. And we can see that it started out at 1104 and ended up at 14016. So merchandise inventory, beginning balance, the ending balance, and the way we get that to go up is by purchasing it. Now, you might say, well, I don't always buy my inventory with cash. I'll do it on account. That's quite possible, but we're going to deal with accounts payable in just a moment. But right now, we're going to assume that we're paying for the inventory with cash. And if you make that assumption, you will get the right answer. And so we pay for that inventory with cash, and that's going to have a negative effect on cash. It is not used up, so it's not because it's in our inventory, and it's going to be a decrease in the cash flow. And we can check off that one. As promised, the next thing we're going to deal with is accounts payable. And the way I like to think about accounts payable, you can do it in different ways, but if you think about it as we have accounts payable, beginning balance of 192 and ending balance of 249.6, we're really using other people's money and borrowing from other people and to pay operating expenses. And there's no cash effect there, right? There's no effect on our cash, and yet those operating expenses decrease net income. And so we need to add that back because it didn't cost us any cash. And so we're going to add that, and we can check off that one. Other accrued payables, things like utilities, they went down from 144 to 96. And the way you get that to happen with a debit is a credit to cash. And so that's a use of cash. And we're going to say, all right, that's a decrease in accrued payables. And we can now check off that. Notice that we've now checked everything on both the asset side and now here on the liabilities and stockholders' equity side. So when we come back here, we can say, all right, we've done the cash from operating activities section. Number 8 says compute the section totals and check the total with a change in cash. Well, what I'm doing here between this slide is just add them up, and I've got 192 positive in cash from operations minus 188, that's a net 4,000 positive, and then 22,000 negative when we add these up, and 4,000 positive and a 22,000 negative is an 18,000 negative. And so it works. It's not beautiful yet, and so I'm going to put some dollar signs in here. We put a dollar sign at the top everywhere above a horizontal line. We have a dollar sign here. There's nothing over here, so we need a dollar sign, a dollar sign. You don't need a dollar sign here because there's no horizontal line in between. Dollar sign, then dollar sign, and dollar sign. And the only thing that's wrong here, and I couldn't figure out how to get it, is this should be a double underline. At the bottom, there should be a double underline here. And it didn't work because of the way Excel interacts with PowerPoint. But that needs to be a double underline. And then you have a beautiful statement of cash flows. You need to go back and check off number 8. Finally, number 9 is where we report the non-cash investing and financing activities footnote. For example, if we bought a piece of land by issuing a note or a mortgage, and there was no cash involved, we would have a non-cash investing and financing activities. That must be reported as part of the cash flow statement. It would say something like, purchased land by issuing mortgage, or acquired land by issuing a mortgage. And that's a non-cash investing and financing activity that needs to be reported as part of the statement of cash flows. So we put that. In this particular case, there are none of those, and so we don't need to do it. But if it's necessary, you put it right there. So there's our statement of cash flows. What can we learn from this? Number 1, we can evaluate the liquidity. Is the firm able to pay its debts when they fall due? Well, we can see that it appears anyway that the way this company is operating, it's generating a fair amount of cash from operations. And when we do it with our, that helps us pay our bills. We don't have to keep that much on hand because we're generating a fair amount of cash from operations. We can assess our earnings quality. Is income a reliable measure of performance? Some financial statements are not very good, but here's a company that has $28,000 in income that's supported by $192,000 of cash from operations. Those earnings, those $28,000 of earnings, those are pretty high quality earnings. And so you can assess in this particular case and say, yeah, the income is probably a pretty good measure of performance that year. Provide information on investing and financing activities. Here we can see, well, we bought marketable securities, we bought property, plant, and equipment, we sold some land, we paid down some notes payable, and we issued bonds, we paid dividends. Yeah, you might be able to sort of infer those things by comparing the balance sheets, but here it tells you straight out what happened in the investing and financing activities. You can't really get that anywhere else in the financial statements. And lastly, we can help predict future cash flows. Typically, free cash flow is equal to cash from operations minus capital expenditures. So let's take a look at this. So we have cash from operations of $192,000, and we have capital expenditures of $240,000. Some people might net that with the proceeds from the sale of land, so that it's net capital expenditures of $140,000 negative. But this difference between 190 and 140,000, 192 and 140,000 negative, some investors, particularly your finance people, will use that to value the future, the company, and discount the and discount the free cash flows, cash from operations minus capital expenditures, to figure out the value of the company. When we come back, we'll do the part 4, which is the direct method statement of cash flows for the operating activity section.